Good morning. Happy Thursday. Thursdays are my favorite days to go live because I get to talk about the new normal. And this, I think, is the fourth in my series of the new normal. And it's where I talk about not only the market we're in today, but the market that we're going to be in tomorrow. And so, as a quick reminder, I see I vision the new normal. Like we're in this, let's say we're in this wood Spanish galleon crossing the ocean, and we're encountering a storm, and it's a bigger storm than most of us have ever encountered, and we don't exactly know what to do, and we're doing everything we can to survive as we try to navigate the boat out of the storm towards the safety of the shore. Now, the new normal is that the shore we're going to get to is going to be completely foreign to us. It's not where we came from, it's someplace totally different. And as a strategist, what I'm trying to do is go, what do we need to be as a mortgage company or as loan officers? Who do we need to be in the new normal to thrive, right? And so we get to that unknown shore full of surprises. What do we need to be so that we can thrive? And my argument is, it may not be worth going through the struggle of the storm if you can't thrive when you land in the new normal. And so my hope is to help companies, help people figure out how to thrive when they get there, or else the struggle probably wasn't worth it. Which I'm not saying don't struggle, fight the fight, but don't forget we still got to prepare for where we land, and that's the land of the new normal. And that's what I've been talking about. This is my fourth series. Last week I got a bunch of really positive feedback. Thank you. It was on how expenses are creating friction with our customers. I related expenses to this friction, like rivets on a plane, and that you got to just grind down the rivets to reduce the friction that we have with our customers. I've previous to that explained how customer behavior is changing. And this week, what I want to talk about is LO compensation. Now, I know that a lot of people that listen to this probably are not going to enjoy my point of view, which is perfectly okay. If my point of view gets folks to think about their compensation and to make sure they calibrate their compensation to their value, then we won. And that's really my point. My point is, I want loan officers, I want real estate agents, I want everybody to earn as much money as they can. That's what I sincerely want, right? But to earn as much money as you can, you have to create overwhelming value or unfair value. You have to create more value than you're charging. And so my challenge is, if you're a loan officer or a real estate agent, do you create more value than you charge for, right? And you have to do an honest assessment. I've heard lots of loan officers explain to me why they're valuable, and they create these string of words that don't really have any relationship to reality. It's like a script that they've created to figure out what they're going to charge without actually creating the underlying value to be worth what they're charging for. Now, I will tell you, I listen. Getting ready for this morning's live session about the new normal. As I do every morning, I listen to a podcast this morning. As I do most mornings, I listen to a podcast from Dave Savage. It was Tuesday's podcast with Jeremy Forcier. I think Dave said it was his 107th time on the Mortgage Coach channel. And every time Jeremy gets on there, man, he brings pure gold. And not only does he bring pure gold, but he really draws great content out of Dave at the same time. So together they were on fire. And I listen to Jeremy, and he epitomizes someone who is figuring out how to create overwhelming value for what his compensation is, right? It's not, look, I want to charge less, it's I want to be more valuable. And that's good. That's really good. I encourage you to go listen to Tuesday's podcast. It was great. Jeremy was talking about unique selling propositions, things that he does for his real estate agents, things that he does for his consumers. And as I was listening to that, and I knew I was talking about LO compensation today, it really gave me a good mindset, because it not only reminds me, but it lets me reiterate, it's not about charging less. It's about giving more. It's about serving more, right? But regardless of whether you give more or less, you have to calibrate your comp to what you're charging. This is super critical, and you can't just make up words and make them seem that those words represent you if they don't, right? Because the thing that we keep talking about, I talked about when I talked about consumer behavior, consumer behavior is changing, one of the things that's changing in our marketplace is where it used to be very onerous to submit an application with a lender. Like, the applicant would have to spend hours and hours and hours getting their documents. It was a very analog experience. Today, where they have a digital file, they can submit an application to 10 different lenders in 10 minutes. I mean, like super fast. And then the level of transparency that lenders are getting, with rates and fees, makes it very easy for them to shop. And so, we no longer can, this is a really important premise, we can no longer hide our fees or our commission inside the rate, which is what loan officers do, what many loan officers do. So I want to just talk about some concepts about LO compensation, and I hope not to offend anybody, but I want to give just some data points, and I'm going to start with what are some of the best paying jobs in America. And to do this, I looked at the U.S. Bureau of Labor Statistics. They list the jobs by income, by average wage. Now, I will tell you the top 10 jobs, which are all in the medical field, they're all doctors, surgeons, those type of things. They don't have great data for it. They did not have a great mean or wage number for it. And that they list it's all 239, 200. They average 239, 200 or more. Well, that's not really accurate. I don't know what that means, or more. And it didn't list in the methodology what or more means. And so, you can also get this from U.S. News and World Report, which somehow tries to improve that or more number, but doesn't really. So what I did is I went down to where is the first, what's the first category where they have a real number. I mean, it's not this number or more, it's this number. And so I picked physicians. Physicians are the 16th highest paying, just general physicians, 16th highest paying job in the United States in 2023. Their median pay was $236,000. The median pay now, the median means, half the people got paid more, half the people got paid less. The average could be far higher, but the median, at the one at 50%, earned $236,000. And to be a physician, you have to get a 4-year bachelor degree, go to medical school for 4 years, and then you have to do a residency for at least 3 years, and it might be up to 7 years, depending if you have a specialty or not. So it takes somewhere in the neighborhood of 11 to 17 years to get to be a physician. And then once you're done with that, you have to then take a test. You have to take this National Medical Board exam and pass it, or a similar type test, right? And so that's what you get to do to get the right to earn $236,000 a year, right? And so think about that. 12 years of intense training and highly competitive programs that you had to compete for, highly specialized, and you have to do this residency where you're working 24 hours a day. It's just brutal, right? To be able to earn $236,000. And I say this because if we compare it to a loan officer, and by the way, the best loan officers should get paid a ton of money. The ones that provide the most value should get paid a ton of money. But how many loan officers that we know that really don't know their craft, don't really know mortgages, don't have financial literacy, don't have scripts, don't have advice, don't really have a customer experience? They're just, in the river of abundance and the fish are jumping into their net, right? And now the market's gotten tough, and you know what? They haven't calibrated their comp. So much so that they become obsolete because their comp isn't calibrated to their value. And so then their only option is to get out of the industry, right? And I would say if those people like the business, start calibrating your comp to your value. Once again, my message though is build more value, be more valuable. If you want to charge more, be more valuable. And if you think about it, the consumer can start to think, okay, look, a doctor that goes to, trains for 17 years, earns $300,000 a year. How much is my loan officer making? Or how much is my real estate agent making? Now, they're not going to think that in their head, but they are going to subconsciously think that. And if we want to be worth more than a brain surgeon, if we want to be worth more than a heart surgeon or whoever, if we want to be worth more than that, we have to bring unbelievable value. And the value just isn't in results, because sometimes you say, look, I'm valuable because I help my clients achieve wealth, and how I do that is I get them a mortgage. Well, the real estate gave them the wealth. Did your strategy give them additional wealth? Did your strategy do something to enhance that, right? So you look at it, how does loan officer comp compare to somebody has to go to school for 12 years. And the only requirement to get into mortgages, right? You got to take a 20 hours preliminary education and you got to get licensed and now you're going, right? And so sometimes we forget that if we want to be top paying professionals, we have to build underlying value. We have to build underlying value in a customer experience and a relationship, right? That we still have to earn the money however we got here. Now, as I talk about this, I want you to think about something else. There's been massive wage inflation in the mortgage industry. And the genesis of this really came with TRID. TRID changed everything when a lender can no longer calibrate a loan officer's compensation to the value the loan officer brought to the company. And after a lot of back and forth negotiating with Congress, they landed on in TRID that we could compensate a loan officer for loan volume, for dollar amount volume, right? And so as a percentage of the loan, because I was only agreed up at the last with TRID before, it's just going to be by units. You're going to get paid by units. But when we agreed to pay, a loan officer on the loan amount, right, as a percentage of the loan expressed in basis points, we removed their incentive to be profitable, which is unfortunate. However, I understand that we were making loan officers being profitable at the expense of the consumer. I get that. But the other thing that happened is we pegged their income to average loan amounts. And so as average loan amounts have increased, LO compensation has increased, and it's increased about 25% faster than inflation. So loan officer comp has dramatically increased. Even if you kept the same BIPS amount, it has dramatically increased. And making matters worse, over those 10 years, since the time of TRID, which is no longer than 10 years, not only did LO compensation increase by average loan amounts, but it increased because they increased their BIPS. As a matter of fact, loan officer BIPS increased up until about 2020, where it flattened out. Where, when I first got into business, the average loan officer made about 60, 70 basis points, right? Where when we were going into 2020, the average loan officer was getting paid 235 or 135 basis points. That's a massive increase. And then if you then compare it to, they're getting paid on the average loan amount or on their loan amounts, and that's been a radical change. I just so you know, I put two links in the notes section here. Both of them are to Garth Graham articles in Stratmore. The first one is sales compensation. Do you get what you pay for? And in that article, Garth talks about a ton of different ways to look at LO compensation, how it's changed over the years, and it has that additional cost and compensation has resulted in customer value or company value. So you can check. That's a great article. And I also put a link to Garth's recent article last month, or current article in Stratmore, why a refi wave won't save every lender and how to prepare. And one of his main arguments is that LO compensation for retail IMBs is way out of whack. They're not going to be able to compete in the refi market. But read both articles. They're both very well read. A lot of data in them. You can get a lot out of them, right? And so one of the things in Garth's second article, the one why a refi won't raise all boats, he comments on average comp by lender type, and both in BIPS and in dollar amounts. So today in the world, the average retail IMB loan officer earns about 105 basis points. About 105 basis points. And it's down from 111 in 2018, he says, but it's 105 as the average. Where an average bank loan officer or credit union loan officer earns 70 basis points. So IMB loan officer gets 35 more basis points than a bank. But the average consumer direct loan officer earns less than 40 basis points. They earn 38.8. And here's what's more striking is if you were to look at that into a dollar amount, here's what's really interesting. Retail bank loan officers have seen their wages increase because it's been tied to loan amount. Retail IMB loan officers have seen their wages dramatically increase because it's tied to loan amount. Call center loan officers, though, are typically compensated flat fee per loan, have not seen an actual commission increase over the 5 year timeline that Garth uses in his charts. It hasn't gone up at all. In 2019, their average compensation was $952, and then in 2023, the average compensation was $985. Like, hasn't really moved because they go flat fee. And so the question is, one of my questions, if you've seen your commissions go up as your average loan amount went up. By the way, if you were going to look at average loan amount, the average loan amount in 2014 was $221,000. The average loan amount in 2023 was $350,000. Now, do you think it was easier or harder to do a loan in 2014? I would argue it's easier, far easier to do. I would argue it's far harder to do a loan in 2014 than it is today, right? I mean, every year with technology, every year it's gotten easier. And now we have these digital applications, and the borrower does a lot of it themselves. And then we use a ton of technology to get documents, even to help us, originate and pre-process. It's never been easier to create a loan application. Now, it's harder to get the client. I'm not saying our jobs are easier, but the application-wise, it's easier. I would argue it's far easier. It takes a lot less labor to originate a loan today. And then on top of that, do you think we have more LO support or less than in 2014? I would argue we have exponentially more. Loan officer, the industry didn't have a ton of loan officer assistants in 2014. It wasn't really a thing. Where in 2020, every loan officer had 2 or 3. And even today, I know we've shrunk our sales force, but we still have a lot of loan officer support. And so today we have a ton of support helping loan officers. Loans are easier than ever, and yet loan officer comp has nearly doubled per loan. Why is that? Has our value doubled per loan, do you think? Have we got that much better? We've gone and we've really learned, how to be great advisors. And which, by the way, the answer could be yes. It could be yes. My fee has doubled because I have absolutely studied, built value in, really serving. And by the way, the value that matters is value to the consumer when we talk about what we charge. And so the answer could absolutely be yes, but is it? We all have to ask ourselves that. Okay, my comp went from $2,000 to $4,000 per loan. What did I do differently? What am I adding? Where's my extra value? And those are things we have to pay attention to. Because here's the thing. The consumer, as we get more transparent and as the consumer gets more, their loan is more portable and that they have more choices, we're going to have to defend how much we pay. And that's what we're seeing with real estate agents right now. The whole NAR settlement and this transparency with buyer agent fees, and now buyers have to calibrate what they're charging to what the consumer is willing to see as value and pay for. That's all healthy, but I'm encouraging us in this land of the new normal where it's going to be very, very competitive. And I happen to believe that we're going to get to, in the land of the new normal, we're going to get to a very monolithic rate, meaning almost all platforms will figure out how to offer the same rate, and LO comp will be very, very similar, with just a little bit of, bandwidth change, from the top loan officer to the weakest loan officer. And so I think one of the skill sets that we have to learn as loan officers is to figure out how to do volume. How do we do more volume? Because it isn't about skewering one client or getting as much as we can off of one client. It's what is the fair rate that we need to charge to be able to deliver the services that the consumer demands and get a fair rate of pay. That's how we should establish our comp. That's what it should be. And then the problem we have to solve for ourselves is then how do I help more consumers with that? And if my consumer wants to pay me less, which means I have to dial back my services a little bit, how do I get more of those clients so that I can do more loans? I think that's what we have to solve for in the land of the new normal. And so check out those 2 articles to just give you some food for thought. One of my favorite charts, it's in the first article of Graham's that I attached, is retail loan officer commissions versus inflation. And as you can see, it's wild. If the average commission from 2010 to 2022, if you just tracked inflation, should have increased from $1,672 to $2,048. But instead, it went from that $1,672 to $3,200. significantly outperforming inflation. All the time it became easier and easier, less work to do an actual loan. Now it became harder work to get a loan. One last thing, and I would go on forever. I could do this for a couple hours, but I want to be sensitive to everybody's time. The one last thing I would leave with you is part of our loan officer compensation has to be what our pricing strategy is. And this is something that I'm super passionate about. We have to have a pricing strategy that says, this is my price, not I'm going to charge you as much as I can possibly charge you until you object. And think, which are you? Which do you do? And here's the way to test it. If you say, look, the minimum that I have to charge, the minimum on this, call it your margin, my margin, let's just pretend it's $5,000 or $3,000, whatever it is. I can't charge you less because I can't provide you the services you demand if I charge you less, right? The way you know whether that's true or not is if they go, well, it'll say your number is 5,000, and they say, well, I'm only going to pay 4,500, and then if you go, okay, then you know what? You don't have a pricing strategy. Your strategy is charge as much as you possibly can, and then just adjust if a customer objects. You have to, instead, we have to go, this is what my fee is. This is what it costs for me to provide the services you demand. This is what you want. I'm the best at what I do, which is why you want to pay me, right? Even though I might be, even if I am slightly more expensive than the person next to me. But you have to have this, you have to have the strategy. That's my fee versus I'm going to put the highest fee out there and then I'm going to adjust down for the people that are sophisticated or that negotiate. That's wrong. You shouldn't do that, right? And so here's what I'm trying to explain. We got to watch LO Comp. We got to make sure that LO Comp isn't a barrier to doing business, doesn't become a barrier for being able to help customers. We got to have a strategy on what our comp is. We got to make sure we have overwhelming value supporting our comp, and then we have to be super confident about what we charge, explaining it transparently to the consumer so that they know what it is and are happy to pay it because they want to get what we can give them. Be sure to check out Dave Savage's and Jeremy Fortier's podcast from Tuesday. It was straight gold. Jeremy talks about his unique selling propositions. Dave was awesome in that. Be sure, if you're interested just on the whole philosophy of LO Comp and the evolution of it, check out Garth Graham's articles. They're attached. With that, thank you for checking out my New Normal series on Thursdays. I appreciate it. Love feedback. Feel free to give it to me. I hope you have a terrific day, and I look forward to seeing you tomorrow. Thanks so much. Bye.